Sunday night, futures looked like they'd been shot out of the sky. By Monday afternoon, U.S. stocks were calmly back in the green. That disconnect is the story. Global markets sold first and asked questions later. U.S. investors leaned into an uncomfortable reality. America is no longer a pure energy victim. Since 2019, the U.S. has been a net energy exporter. That changes the math. When oil spikes on fears around the Strait of Hormuz, Europe and parts of Asia feel an import shock. The U.S., by contrast, has a built-in offset. Higher crude doesn't just raise gasoline prices, it also boosts cash flow for domestic producers. And that showed up immediately. The S&P energy sector surged nearly 2% to a record high, helping stabilize the broader index even as headlines screamed escalation. The market wasn't ignoring the bombs, it was reallocating around them. The second layer was psychology. Investors have been conditioned for years to buy when the missiles fly, and Monday looked like another test of that muscle memory. The Dow opened down nearly 600 points, then clawed back almost all of it. That kind of intraday reversal tells you dip buyers weren't timid. They were waiting. Now, that doesn't mean risk is gone. If oil stays elevated for weeks, inflation and global growth become real problems. For now, U.S. equities traded on relative insulation. Net exporter status plus strong domestic positioning made America look more like a beneficiary of higher energy prices than a casualty. The market didn't shrug off war. It repriced who wins and who loses.